just one moment. Yeah, so this is Finance Meets Real Estate. We do weekly webinars every Tuesday, this week on Thursday. But it's, so we are a weekly series. We're on YouTube, Finance Meets Real Estate on YouTube. Go find us there. And today I'm going to be talking about data-driven real estate investing. So it's from the perspective for real estate investor, like what, data analytics, data science methods one can use and what tools are out there from my perspective. Things that I have found, I have discovered useful. So this is the topic for today. Just one moment. So if you guys have any questions at any point, feel free to put them on the chat, or you can just speak up if I get carried away too much. Sorry. Yeah, so I'm the founder of Realty Quant. So it's a company that brings like data-driven techniques to the real estate industry. And I'm an investor as well. So I live in the New York City area. I recently moved to New York City, broader city, so to say, from New Jersey. And I'm Eastern European originally. I earned my master's degree in financial engineering some time ago. And I had a finance career managing a derivatives portfolio. And so the topic for today. So like I just wanted to touch on like several different tools that are out there for data-driven investing. So these are some of the topics. So just as an introduction, like what is and what is not, I would say, data-driven investing. So my perspective is when it comes to the real estate industry in particular, so my perspective is data-driven investing is mainly one of those 6 bullets, call it. So it's, in the event of either on or off market, commercial, residential, automated underwriting. And automated means really end-to-end, like via scripts. So kind of getting it all done as much as possible. As well as if possible, like some of the intelligence components of that. And so that's like the simplest example is like if one pulls like zero data, and kind of underwrites all the properties there, like all the houses and, like what are the cap rates, what potential equity gain one can earn, etc. So doing that programmatically as a mindset via scripts. So that's kind of like some of the topic today. For commercial multifamily, there is a slightly different approach where, at least in my mind, where for commercial multifamily, okay, being primarily like nearly zero usefulness or very little usefulness of on-market data. So it's about off-market. Now, once it's off-market analysis, I wouldn't call it underwriting. It sort of becomes modeling. So it's modeling off-market commercial multifamily data. And then on the market side, it is performing statistical regression analysis to what in my mind is to arrive at valuation, like where markets are valued, if they're overvalued, undervalued, and how are they really performing relative to their valuation and relative to their fundamentals, market fundamentals, automated valuation models. So that's kind of useful to investors to discover price inefficiencies. And then there's like 2 last pieces, which are, kind of more technical, kind of machine learning topics, which are, okay, how to score conditions of properties. And I will show you like in this lecture, like some like simple ways and like tools to do it as for scoring like the condition of images or textual descriptions of properties, which is an important thing as well. So what data-driven investing is not, in my mind, well, manually underwriting deals. So not performing analytics, let's say on off-market data, just kind of pulling feeds. Then sort of selecting like several trendy markets, like how investors, we often like to do, like we pull like a market and we kind of back reason like all the like population and like all the reasons in terms of, there may be valid reasons, but kind of population growth, income growth, etc., that have justified the historical price growth in that area and maybe project those, but kind of like do it on a pretty narrow manner rather than having the same analysis for, I don't know, let's say every zip code or every county at least in the country or something like this. So that, and then, so I mean, manually gauging property values, it's obvious it's a more accurate approach in many cases, but it's not data driven. And then reading reports. Let's say if one pulls a Marcus and Millichap report, reads the summary rights reports, in itself data driven, in its derivation is, well, in my mind, not data driven as far as the methodology or approach to an investor, because it's hard to assimilate. One needs to get an intuition with the data. So I feel like the two things should work a little bit in parallel. And then utilizing no risk management techniques is for the downside risk, particularly in real estate, because at least my perspective, like coming out of finance, for me, it's like a blessing in real estate where one can know valuation, one can measure downside risk. The reason is it's like you're buying utility stocks or something, right? There is a measure of valuation where it's not Tesla, it's not even Google, or it's not the technology underlyings. And so that's like the topic. So the goal is like to get to know like some glimpse into data-driven principles and techniques, and kind of inspire a new vision and mindset for that. So I mean, naturally, so if you guys don't like to code, then you can maybe hire somebody to do it, So that's one option, but it's just kind of trying to show the mindset, or maybe like purchase different tools. Like I said, that kind of doesn't foster some of the intuition there, but yeah. So Python is the prevalent language, right, in data analysis, in web development, scripting. So it has grown like significantly over the recent years in popularity. But then there is like another, I would say, like kind of technical concept that I found very useful, at least for myself, like in pretty much any entrepreneurship, is so kind of having an understanding of web fundamentals and like web technologies, and sort of like knowing like HTML, JavaScript, and things like that, and like database languages even, and so forth. So it kind of gives a perspective as to understanding the web and understanding how to get data on the web, how to automate things on the web, and essentially, really, it's a wealth of, short of like various legal considerations indeed, but it's really a wealth of capacities that one can have for his business in literally any industry. And so that's kind of the legal guidance. It's very super much by terms of service of in the event of using any publicly available resources, so to say. So kind of to consult always an attorney. So yeah, automated underwriting. So as I mentioned, so if one looks at the example of houses, like houses that appear on Zillow or Realtor.com or like different MLS feeds, like MLS is like the Realtor multiple listing service. So those, the sources for that would be like some of those that I mentioned. In my mind, in such sense, the best source is actually Redfin. And I can just explain as to why, like these technology companies, they work differently. Redfin is a brokerage. Being a brokerage, they are literally a copy of the MLS in the regions they serve. And in the regions they don't serve, they don't exist. So it's a blank there. It's a particular county, there is no Redfin, that's it. But if they do exist there, it's actually a very deep thing. And again, like that's not for commercial purposes. This is just purely testing and own work. So that's that. And Realtor.com has a little bit of depth, but not too much. And then maybe Zillow and Trulia, which are kind of market pricing kind of aggregators a little bit, they seem to have the least depth. Sometimes you can't even figure out how many units the property has, let alone to underwrite it. So that's that. And then there are vendors. So there are like some interesting vendors. So one is like Data Affinity, have incredibly rich rental listings data, also on the commercial side. So on the commercial side, this is very useful for modeling, and I'm going to come to that later. So Data Affinity is one vendor. Tovo Data is another, and then there is like companies that kind of would do the web scraping for you, like Scrape Hero. So these are, so one can connect to the APIs of Data Affinity if one does that, one would sort of get probably most of the listings data over the internet, and then it's with some questions as to how the data affinity sources it, etc. But that's again, for certain use cases, it's can be valuable. And then one needs to kind of build up his model. And I didn't want to be like showing like codes and stuff, but let's say some functions that one may use for this are, okay, if you are pulling like a resource like Redfin, let's say. So you need to pick there's going to be a geographic origin, there's going to be like certain property types that one is searching. And sorry, just one moment. Yeah, I'm sorry. So one kind of needs to build his URL like for the search queries that one is looking for. So just kind of the general approach, and it's mostly the same at like every, let's say, resource, and then kind of like pull like the URLs of the search results for that, and kind of like build up like a listings data frame, call it, and we'll sort of like scrape all those pages, build up a listings data frame and then analyze it. So that's kind of like the general approach. So these are like some of the functions that one may want to build. And then some of the challenges is, okay, data is non-homogeneous and data fields. So one may have thousands of data fields, or like one may have 20 data fields for a specific category that one expects. Let's say number of bedrooms or something like that. And then, one may have like lots of data fields in total, and can be like pretty tedious, and then different data formats, etc. So extracting large data sets can also be time consuming. So the main package in Python that does like browser automations and can also scrape, but it's not fast for scraping, is called Selenium. So that's, let's say if using that's not particularly fast. So data outside of, and it's less of a concern for APIs, like for some of the data vendor APIs like Data Affinity, it's less of a concern. So data outside of discrete fields, like that needs to be classified, like reading property descriptions and things like that to infer stuff that just wasn't contained in a discrete field, like how many units does a property have, or condition scoring properties is the other example. And then the other thing is to really model that. One needs to go to multiple sources. One needs to pull like some demographic data, maybe geolocation, crime rates, etc. And so it gets like, can be a bit challenging to go to like all those different places and build that. So that, and like, what are some of the outcomes? Well, the outcomes is, and it's really both on the commercial and the residential side. And on the commercial, as I mentioned, it's primarily for off market, and I'll come to that. But it's really like one ends up having evaluated like thousands of listings automatically. Of course, this evaluation is not perfect. Then one looks at it in depth, etc. But it is one level of analysis that is, I think, very useful. And so one can get, and in addition, so by doing so, one kind of scales his even mental capacity towards multiple strategies. So if one otherwise would think of like be focused on a single strategy these 3 months or something, or years sometimes, this way one can kind of, okay, build up his tool set of strategies and kind of like have the whole data set kind of priced out on all those. So, have, what are the best, cash flow, like value add potential, maybe like some undervalued properties in illiquid markets, like residential to commercial conversions, condominium conversions, etc. And that's what I've been doing actually myself, like with like applying like different strategies by pulling data for thousands of listings and just looking at like, oh, what are the things that rank best for condo conversions or some of those other items on the list. So the goal is like to discover an efficiency, and essentially it becomes a mindset of kind of trading the US real estate market, sort of, using data. And then one derives output feeds, and I just kind of just showing like a simple output feed where one can look at, just cap rates. But like I said, it's really for multiple other parameters. So condition scoring is an interesting topic. So condition scoring, if one thinks about automated underwriting, condition scoring is probably the biggest roadblock, or like the biggest challenge and thing that needs to be, that is really figured out, but that is going to be most challenging for most people and myself as well. Because really, like if you think about like all data that is out there on properties, so one would be able to analyze it, like just pull it and like do some numerical calculations and compute cap rates, etc. But then really, you know, if it comes to reading the descriptions or the images, then one needs to have a team or people or, you know, looking at it and kind of like reviewing those tens of listings or thousands of listings or etc. And it's really, you know, it's really tedious. And I'm sure many of you have found that underwriting deals is really, really tedious, and it kind of takes a lot of hours. So condition scoring is one of the elements that can kind of take some of that away. And so it's via machine learning algorithms applied to computer vision and natural language processing, right? So, so if we take the example of real estate descriptions, condition scoring via NLP, so some of the packages in Python are like, again, same Word2Vec, Doc2Vec, NLTK, and TF-IDF that are useful. And so I've done this on my end, like in two different ways. So one is like the old school way is regular expressions. So regular expressions is kind of like what I'm showing on the picture above, like kind of building elaborate combinations of like different phrases and characters, and like with a certain, it's a language or syntax that would kind of try to capture what you're trying to match and achieve, and like trying to capture, okay, if this is a well-maintained property or a renovated property, or if it's in poor condition and it needs complete rehab. And so this, like the old approach, is regular expressions. And then natural language processing models, they're, you know, they're kind of an expansion of that, or I mean, and they're kind of like the newer way, better way to do that. And so to achieve those, what one needs to implement is kind of build a table like the one I have to the bottom right. I mean, of course, with like maybe like thousands, ideally, of those, let's say, property descriptions, and to kind of score them, let's say maybe hire a VA, like a virtual assistant, to kind of score them out manually. So one needs to have kind of as a dependent variable, a human-generated conditions data, and then do some pre-processing like of the textual descriptions, like stemming, lemmatization, and vectorize. So the approach that is in this, and I know like most people, you know, maybe don't care like specifically about technical methods, but again, it's just the approach, and then somebody can do it for you. And so it's really, so the approach of Word2Vec, for example, is vectorizing, sort of numerizing the space of language. And then if you numerize the space of language, you can run regressions on it, okay? And then you can kind of figure out stuff. And you can, if you can run regressions, you can predict stuff. And so then you can have now descriptions that you can predict, and you can get the scores of, the condition scores of properties, for example, of 1 to 5. Let's say for my needs, I primarily look at it, like these kind of 5 categories tell me enough. You know, if it's a 1, it's a, let's say, perfect condition. If it's a 5, it needs a complete renovation. And then from that, one can base his renovation budgets on that, and things like that. And so word vectorizations is the technique that is used for that. And then there are like classifiers that sort of for building the regression and getting the predictive model. And yeah, and for images, so I haven't done it myself, I didn't have time, but for images, condition scoring is done via, so computer vision algorithms. So these are some companies who do it. Foxy AI in New York City, Vin Vomero, I believe, is their founder's name. I'm not associated, but they seem to be the leader in real estate properties condition scoring for images. And then there's restb.ai. And if you want to do it yourself, you have to build your own model in OpenCV in Python. And again, like that's kind of part of the point of this lecture for me. So all of those things are available. So one can go to OpenCV, you know, work out different tutorials online, you know, build different models, you know, if you want to get hands-on about it. So that's with regards to images. And because if you think about it, if one is able to read images and it can be on, like I said, on commercial side as well. It really becomes, it allows you to preliminarily underwrite many properties. From there, you would still need to do your final underwriting in a human way, I'm sure, for various reasons. But being able to do this is still very valuable in itself, and kind of it allows you to scale your analysis. And yeah, so commercial multifamily modeling. So this is the third topic. So commercial multifamily, I presented this some time ago in more detail. So this is, so as some of you know, in commercial multifamily, valuation is done predominantly by the income capitalization approach. So there is a market cap rate, and then there is a net operating income for a property. And so the net operating income divided by the market cap rate, this is what the commercial building is worth, or a commercial property is worth. And so if one wants to improve the value of the property, one raises the NOI, or aims, assuming the market cap rate stays the same, one raises the NOI of the property, raises the value of the property respectively. And so that's kind of what every commercial multifamily operator aims to do and wants to do. And it's, you know, in my mind, very much an equity game in commercial real estate. And so that's what allows that. And so how does one model this and use a more data-driven approach to this? So if we think about like the predominant, like what are the main approaches of researching commercial multifamily now? So it's agent relationships is the big one, and will be the big one perhaps for a long time. But besides that, it's also it's also kind of having feeds of property inventory in specific markets, and then doing like direct to owner on those properties, like direct mail and etc. So those are, I would say, like the two predominant methods in that space. And so there are different vendors like Reonomy, Prospect Now, Yardi Matrix, who provide the data on some of those properties. And what I feel like most people use is, okay, what's the inventory in a given market, and then what are the the owner information, so that you can direct to owner to them. And so those are kind of the, I would say, current approaches or traditional approaches. And so my methodology that I put together in this model is to go a step further. So coming back to like my point from before about like internet technologies and kind of being able to connect that and utilize like every data point that is out there, like to your analysis and to your insights goal. So for commercial multifamily, that is one space that works relatively well. The reason is, if we think about, if we want to underwrite a commercial multifamily property, and this is an off-market property, and again, like this analysis is only for off-market. So if we want to underwrite an off-market commercial multifamily property, so we're given an income expense sheet at some point. So we have already, maybe gotten a response from the owner or the agent, etc. And we essentially we're given, let's say, what the income and expense data is or details are on that property. And so once one has this, and then like going deeper, like trying to understand if all the numbers are correct and etc. Right? If they're not exaggerating different aspects, right? And so forth. But based on this income expense sheet, then one infers, okay, what's going to be the value add on that building? And then this is kind of like if rents are below market, or as well, like looking at that, and if some of the expenses are maybe not perfectly optimized. And so try to utilize, and then this is kind of your analysis. Is this a quote unquote deal? Is this something where, it's, at least in value add, there's like core commercial and another perhaps subsectors, but let's say in value add commercial real estate or commercial multifamily is the approach. And so with here, I had put a model where one can go to rental listings data. So one source for that is CoStarsApartments.com. I do not specifically recommend going to them, but they happen to be one. So that's one source of rental listings data for commercial multifamily, and then their commercial multifamilies get posted on various other websites as well, to a lesser quantity, but it's pretty relatively spread out. And so based on the rental listings data, one can collect some of the following piece of information. So what the rent levels are and the unit mix, approximate the unit mix based on like what units are coming out, whether they're 1 bedrooms, 2 bedrooms, etc. What units are coming out as listings, and then one may be able to see other income information as well, such as what fees they're charging, if they're one-time recurring fees, like pet fees, administrative fees, application fees, etc. And to infer what their occupancy level perhaps is based on like how many listings they have available or they have posted, and then to see what their utilities expense may be, or like percentage wise, as percentage of NOI, call it, or as percentage of gross income, let's say, call it, based on like what utilities they're billing to their tenants. And this is all information that is available in rental listings data. And so by pulling that, one can get this information and also compare it to the immediate neighborhood, to other buildings in the immediate neighborhood, and sort of discover a deal. So sort of like discover, okay, if our rent levels go market, our other income components go market, etc. And yeah. So the steps for that is really like scrape or source public data online, or purchase vendor data such as Data Affinity and other vendors, and perform like automated modeling on top of the data, and then produce summaries. And the modeling steps are to compute like the estimated value add, like NOI increase percentage, and kind of rank properties. And then let's say the final vector ranking code would be your predictor of, what is hard to validate later, but it's really your predictor of like future rankings of what's going to be the real value add in the future that one would realize. So basically the goal is, if one goes in a market, and let's say you're going to have the Reonomy feed instead, and then in the Reonomy feed, you have like 200, 100 buildings in that market. And here the goal is to kind of model out, these buildings are off market. We don't know much about them. We don't have their income expense sheet, but how can we, based on online information, how can we infer which are the best ones? And then these are the best ones. And then one can maybe do a more different kind of direct mail campaign, maybe like hit the top 20% in different markets, or, instead of just going to a single county, or, kind of like take a different approach. And so like validating the model, so it's kind of challenging. It relies on like having like commercial resale transaction data subsequently, and etc. So this is like another example that was of like data-driven investing. And AVM is something people talk about a lot. So before this lecture, I actually got a couple of angry messages on LinkedIn about iBuyers. So this is not a lecture about iBuyers. I don't specifically endorse their business model. I don't know much about their business model, etc. So it's not an endorsement of iBuyers in any way. But AVM has a series of applications, and it's typically what an AVM is. It's really machine learning algorithms to value properties automatically. It's more used on the residential side, perhaps than commercial. And then for like marketplace value estimates, like Zillow's estimate, for example, or iBuyers, or like appraiser, mortgage, like lending industry, and perhaps like home value estimators for, let's say, new like first-time home buyers, etc., like startups like Ownerly, etc. So that's AVM. But the context of that I'm including it here is kind of more like investor applications, like how do we care? To me, if I want to purchase a property, and if this property happens to be already on market, and now one can say that many investors are skeptical on market, there are no deals, right? But let's say if you own market, I agree, there are very few deals. But on the other hand, you have deep data about those properties. So you're able to study them. off market, there may be many deals, but it's also harder to study them. So it's kind of a trade-off, right? And so on market, if one looks at let's say trying to find like the top 0.1% of properties or something like this, and having a basic AVM modeling can help you. So, and when I say basic, I really mean, if you look at the function to the right, this is kind of like the implementing function of the most simple AVM that is, which is a gradient boosting regression in Python. So that's, and there was a guy on this webinar, Shreyas, a friend of mine, who presented, he had an article on Towards Data Science, and he presented like his bit more detailed, like he had like a larger data set of, but still kind of really the same model of, doing an automated valuation model. And he got a lot of claps and stuff on Towards Data Science. And so I had him present for Finance Meets Real Estate last year. And but what it really is it's really a machine learning regression. It's several lines of code of kind of in a simple sense. Again, this doesn't mean it's going to work well. This is, assuming the housing stock is like very homogeneous and like in a particular, let's say, zip code, and if one cleans up the data really well, etc. But then once have this, suppose you're in an illiquid market. And by the way, knowing if you're in an illiquid market is very well understood by market data and market valuations data, which is I'm going to come to as the next topic. And so if markets are illiquid, if we take the example of many parts of New Jersey and New York, right, where I feel like people in the Northeast, they keep saying it's competitive or something. I don't know what they're talking about because it's really, really depressed, right? So and if one goes now, I guess that's a more obvious one, but if one goes upstate New York, it's like crazy liquid. And so there's like tons of inefficiencies, and one is able to discover, be it by running an AVM or like just pulling data on like tax from county tax records, even on like their estimate for what a property should be worth. Even that has value sometimes for like discovering like an undervalued property. And so this kind of like gives you in-house modeling that's fairly easy to build and helps you discover pricing efficiency as an investor. And so data recurrence, so like I mentioned, kind of should be more homogeneous, the housing stock. And really like the key thing in like the basic AVM model, in my understanding, is if we think like in real estate, like people say location, right? So the location is the biggest determinant of price, let's say, high level speaking. And so location, so the key here is to numerize the location, have a like the latitude and longitude, like in the geolocation coordinates. And then the idea is that that's where like some of those better algorithms of machine learning come to help, and where AVMs got better, because now this sort of location nonlinearity, if you have a very rough neighborhood and then next to it, it's like an amazing neighborhood, and they're like right next to each other. And then next to the amazing neighborhood, then there's maybe another rough neighborhood or etc. And it's just, let's say it's like non-linearly distributed. And so, which is generally the case for location. And that's where machine learning and things like gradient boosting and perhaps other methods are useful. And so that's what allows like AVMs to work, numerizing location and having, methods that are able to capture nonlinearity for that. And then some qualitative factors can be numerized also. And this kind of like a basic feed, if one wants to put like a basic feed they put together for Hudson County, New Jersey, for, I don't know, like properties with like number of units and locations and etc. And so the next topic, so I'm just giving like an overview of like several things. So the next topic is valuation. So I've spoken about that one more. So valuation, so this is my personal view that I really stand behind, which is in real estate, market valuation works. So in real estate, if one does let's say a regression of whichever you believe are the real estate fundamentals, well, which do tend to be income, population, and housing supply. So, and if one does a regression of those fundamentals and then takes some kind of historical aggregate metric of that, median or average or etc., and then if prices deviate from that, this is a strong statistical predictor of downside post to peak. And so some of comparable studies have been done in finance. Now, so this is like the more famous person who does this is like John Hussman at Hussman Investment Trust, which is a hedge fund. And he had an article called Measuring the Bubble. So now I don't know like how he has constructed his model and etc. But it's just the concept of, if you look like in finance, there are price earnings ratios, and then you can build a better metric maybe than that. And then the concept is just to stop and take out all the guesswork from the market, to not keep wondering if the stock market is overvalued or not. Now, that became extremely challenging. Now that the stock market is driven in its changes primarily by the big technology companies, then how does one do it? It's super hard. So now we don't know what measure of valuation. One probably needs like more advanced methods to capture it. And so I don't know if the stock market is overvalued or not. I mean, one intuitively thinks so, but I thought it was overvalued before, and then it's fine that it keeps going up, but I never had a measure of what the downside exposure is going to be. Now, in real estate, on the contrary, is different. It's a fundamental asset. So I've been kind of urging people to use valuation metrics. So if one does a regression on fundamentals, one would be able to arrive at how overvalued or not the market is. And so in 2007, these were the downturns that happened. The four big states that dropped at the time were California, Nevada, Arizona, and Florida. And these were valuation metrics based on like kind of historical price and income time series. And sometimes, and I explained this thing actually at like some events where people tend to think it's just income that predicts this stuff. And it's like, and then they look at the affordability index and things like that. Affordability index does not predict downsides post to peak. It's a different dynamic. It's because when you take the changes of, like, let's say incomes, affordability kind of shifting over time, it tends to shift over time with housing shortage, which is population to housing supply ratios. And when this happens, that's when this happens in an excessive way, then that's the overvaluation. And then that's actually predictive of downside post to peak. But absolute figures of any of that is not predictive of anything. And so these were like some of those percentages at the peak of 2007 in the same four states, California, Nevada, Arizona, and Florida. They were very high. And, as you see, those were the states that dropped very much. And if you look in the middle, there were states that were even slightly undervalued, like even Texas at the time. And they barely dropped. So that was, so that is like market valuation. So where is the current valuation? And now, so now valuation is, well, fairly too overvalued as of the third quarter of 2021. The year-end 2021 data hasn't come out yet from government agencies. But what I want to note there is, so these metrics were very consistent for 4 years. I haven't tracked them for 4 years. I hadn't even thought of this thing a year and a half ago. But when I did, I computed all the historical levels. And so if one looks at, like the big states for investment like Texas and Florida, they were in the range of 8 to 10%, slightly overvalued for 8 years. And this was confirmed, by the way, if you're thinking that this is, like just my analysis or something, this was confirmed by a study by Bloomberg Economics, high level confirmed, where they were showing until in 2019 and even early 2021, they're showing US real estate as fairly valued. And they in fact were showing many other countries as very overvalued, which is Canada and New Zealand, Australia, and countries in Scandinavia and a little bit UK, but US was actually fairly valued. And so it was, and then there are other studies. There's one at like Florida Atlantic University, and then there's like some other ones, and there's local market monitor and like some other places as well. And so, but high level US real estate, to some investors' surprise, until 2021 beginning, the first quarter was actually fairly volatile. And so what happened in Q2 and Q3 is it seems that the excessive inflation that everybody started kind of raving about and kind of buy hard assets because there is excessive inflation, because there is inflation, well resulted in what in my view is a little bit risky, which is when asset inflation exceeds wage inflation. And so, okay. And so now some of the Western states, particularly Idaho, Nevada, Utah, Colorado, and Arizona went, in my opinion, and call it bubble territory. That doesn't mean with first indications of entering that territory, which means it can really take them staying there for 4 years or something, and then this thing to correct, if it does correct at all. But really, there's no prediction as to timing, but just like the first indication of actually entering this kind of sharply overvalued territory, where the state of Idaho in 2020, let's say year-end 2020, was the only overvalued state at 25, sharply overvalued, 25% overvalued. And Boise has been reported, like multiple sources, like I mentioned, including Florida Atlantic University, and like data scientist Neil Bawa, he speaks of Boise what is the best market in the US this market cycle, which is completely correct. It has the best price performance out of 800 cities. It nevertheless went very overvalued. And in those measures, like when looking at kind of like a regression-based statistical historic approach. And so, so that's like, and that went way worse in the second and third quarter. And I was surprised because I was like tracking these things at the beginning of COVID. I was even lazy to update the data, like I was just like, it's always the same. And then some of those measures suddenly, like Q2 and Q3, kind of like boom, they doubled. So that's like something for people to think about. Doesn't mean that some of these same markets are going to continue being the strongest ones until they reach peak. So real estate is a trend-driven predominant in most regions. It has autocorrelation. And so places like Arizona, which are booming, they will continue to boom. And so what people say, there's inflation, things are going to continue to boom, et cetera. I mean, yeah, sure, I don't doubt that. But the question is, if it does exceed the fundamentals at some point, then, then that's going to be your measure of downside risk after this. So the same booming markets are going to continue booming, but then they're going to have maybe a bigger exposure after that. So that's kind of like this analysis. And so, yeah, so some of the cities that are in this measure most overvalued, Boise, Phoenix, Tampa, Fort Worth, Las Vegas, and St. Pete are some well-known cities, and some other ones in the list. And if you look at to the right, there is like what they call like fair valuation to current price change. And so fair valuation is like, when was the last time this market was fairly valued, and then like how it performed since then. And so, those are like really strong, predominantly. I mean, they're pretty much all of them, like really strong markets, and some of them have gone overvalued. It's not that every strong market has gone overvalued. At the beginning of COVID, I was like speaking of Denver, Colorado, actually, which is a city that at the time was fairly valued, and it was like top 5 by price performance in America, in the big 100 cities. So it's not really necessarily the case, but it does tend to be the case. And I feel like there are many investors who feel that if a market is strong, as if it has some kind of immunity to downside risk. That's not correct. Immunity, real estate has a different dynamic than stocks, in my mind, where in stocks, if we look at something like a penny stock, well, it has a very big downside exposure, right? It's like super volatile. But if we take real estate and we look at, let's say, US real estate and some of the poorest states like West Virginia and Arkansas, Mississippi, they never had a big downside risk exposure. If you look at it, neither in 2007, neither they have now. And so they don't drop much, even though they're supposedly weak markets, but people don't leave their homes, they don't sell their homes if just like that. It's a different kind of dynamic. And so yeah, so that's that. Yeah, and then the cap rates and interest rates relationship is, so this is just another caveat. So if one does, let's say, this study, should one adjust for interest rates? Because one is going to say, now interest rates are so low, this is nonsense, why are you even using it, right? But then so if the example where I think that's a very strong argument is, if one was basing valuation on something like price to rent, So like price to rent ratios, which I've seen some economists do, and I don't know why they do it. So then one needs to like take interest rates and adjust and like do like an extra regression or something and adjust to that, to the low level of interest rates we have now. So because like price to rent is, let's say, I mean, approximate, I mean, there are like some of the expenses that go into cap rate, but let's say kind of approximate inverse cap rates. And so price to rent ratios being approximate inverse cap rates correlate with interest rates. But market valuations based on the income time series actually don't. And so I did like this study where I showed like a history since for 45 years of what has been the price to income ratio in the US, which has been around 6. And as we know, we're in a 40 years downward cycle of interest rates. And so it doesn't seem like it needs to be adjusted for interest rates. So that's that. And then the last topic, just like a quick example. So like a topic is very spoken about, real estate tokenization. So like the potential entry of kind of like DeFi, like decentralized finance into real estate. So what does this mean if one wants to implement this on his own or her own? So if you know, like there's like 4 types of blockchain tokens, like payment, utility, security, and non-fungible tokens. And real estate tokenization is typically, now there's like some discussion of NFTs there, like Propi is one example who do NFTs in the real estate space or did an NFT real estate. But more typically, it's a security token. And the security token is mapped to shares in a special purpose vehicle. And so to do that, just like I'm just giving like the general procedure is to create, one can create, can put tutorials online, like create an ERC20 token on Ethereum, such as it means like get a piece of code. So what a token is, it's really like a piece of code that gets uploaded to the blockchain. And that code has several functions, and it creates the token. It has a transact function and maybe some other functions. And one of the language that is used on Ethereum typically is called Solidity. And Ethereum has their integrated development environment, and one can put a piece of code and create a token on his own. And that's going to be a ERC20 compliant token. Then that means that's going to be what is used as a security token. So that's essentially what could serve as a real estate token. And here is like me creating a one for Realty Quant on Ethereum. And so then one needs to like reach to an attorney and like set up all the details subsequently based on that. Now that's going to give you more flexibility, maybe, just working it out yourself versus the other alternative that is more readily available is going through real estate tokenization companies like Reno, DigiShares, etc. But this is just like I kind of want to put it out there. It's actually not that hard to create a real estate token if you have a good attorney. So yeah, so that's like the summary. So like, certain topics that kind of, in my opinion, give competitive advantages to real estate investors today: automated underwriting, off-market modeling, condition scoring, AVM. So those are like the data-driven tools in my mind that give a competitive advantage. And then market valuations furnish a statistical fundamentals approach to assist in market selection and minimize downside risk. And blockchain development can be used to expand and strengthen the ecosystem in real estate. And it's really in infancy. So it's kind of a new vision and mindset for real estate investing. So for further info, this is my information. I'm supposed to launch a course on data-driven investing with Python next month if I get to there, since I've been busy with other things. And if you want to invest with us, that's the link as well. And we have market valuations data as well in my YouTube channel. So with that, if you guys have any questions, yeah, I will share the PowerPoint, sure. If you guys have any questions, feel free to ask me. Hi, Angel, how are you?
I'm doing all right. How are you?
Good, good.
One of these days, I'm going to better understand everything you put out, but questions. I'll get
So
there.
it's just to give a glimpse of what's out there, that's all. And yeah, I mean, I think what's going to be useful to you, I think like some of the commercial modeling can be very helpful, like some of this stuff. If you get like somebody to pull like data online for various commercial properties, it's a great approach. Actually, I'm supposed to launch a product on that, but anyways, I haven't had the time to. So. Mm-hmm.
Well, sometimes taking care of those things is a little bit more of an involved process than we think at the outset.
Yeah, that's true. Some of it is pretty quick, like some of it one can do like in a couple of hours, and some stuff is really tedious indeed. Yeah.
Quick question. Can you give an example, like, let's see, using LoopNet to utilize the machine learning strategy and find, property which is already listed in the market, LoopNet, commercial?
Mm-hmm. Well, on the, let me try to, let me see. Well, I mean, the thing is that, let's say WhoopNet, I mean, that's the kind of, I guess, automated underwriting. So that, I think I did that sometime in the past. I have it for Crexi myself. So let's say I do it for Crexi. So I kind of try to study their data and like if there's some kind of deal potentially. And I haven't been pulling it more recently. But I would say there isn't machine learning to that, other than if you want to do, like the condition scoring or some kind of neighborhood trend following and things like that. It's mostly just pulling the data and underwriting it. And I would say the main machine learning that's going to be very useful is actually for WhoopNet. Okay, look, I think this is a good example. If we take like multifamily in, I don't know, it's a state of Virginia or something. And then on WhoopNet, it happens to be that like what's of the information is just literally, they've just written out a summary about the property. And so that's where what I described as like the NLP or regular expressions are extremely necessary, because I cannot underwrite this damn property here. It's like it's all written out in their textual information. And so one needs to either use machine learning to classify all those descriptions for different properties and kind of put them into different buckets, or like put together different regular expressions to study that. But other than that, if one wanted to use something like WhoopNet or Crexi, the general approach would be to literally pull, and I don't want to be showing like my codes for this thing, to be honest, at this time, but one would just literally pull all the data that they have, really, because it's pretty straightforward for multifamily. It's not too many listings, and then probably compute what you think are the real cap rates, not what they're writing themselves, and then what you think maybe are projected ones, and try to infer the value out, like how much you can raise the appraisal on those properties. And then the other valuable thing of doing it in this data ways, then you're going to append to it a bunch of demographics and so forth. So you're going to have for every single property, first you're going to have every single property with some Crexi anywhere in the US, which is fairly easy to get. And second, you're going to have appended to it all the demographics, etc., crime rates, etc. data. So you would have to, you would be like very quick at filtering those. So that's like, I don't know, that's kind of the basic example of like automated underwriting. The more interesting thing is like what I was mentioning with things like apartments.com. And let me see. So if we take, let's say Atlanta, Georgia, and select We select apartment buildings. And then, so what happens is that when one goes to each of those listings on apartments.com, and if one pulls all the data, and again, like I strongly caution against specifically apartments.com because that's CoStar. But you know, like, so that would be the inventory in a given market. And so if we look at now at particular property, it's going to tell us, it's typically going to tell us how many units it has. Sorry, I'm not able to get to that part apparently. So for example, this one has 210 units. And so instead of, let's say, going to Prospect Now, or besides going to Prospect Now, if you have your feed of stuff in Prospect Now or other like data feeds, one can, by using this information, one can get much more, because now I have this 210 unit building. You know what the rents are for every 1 bedroom, 2 bedroom, 3 bedroom apartment, or not every, but the currently listed 1 bedroom, 2 bedroom, 3 bedroom apartments there. And let's say that's not the existing kind of, that's not the rent roll on the ones that they currently have. It's just the new ones. And maybe they're priced at market, but maybe not necessarily. And they may be priced below the immediate neighborhood. And so one can go to neighborhoods, like one can put what the neighborhood is for this, which is called Peachtree Heights in this case. So one can pull what the rent levels have been per number of bedrooms for this neighborhood and for the same building cost. Because here one can, there's also like when the property has been built. And there is also, you know, sometimes, well, just when it has been built. And I believe somewhere when it has been renovated. And so one can get the building cost. And so for the same building cost, same number of bedrooms, same neighborhood, what are the rents that other buildings are listing at? This one is listing below. This is your effect on NOI, sort of by some approximations, and like how much you can raise the appraisal. So this is an approach there. And but this is just rent. So this is, let's say, more obvious. But then if you take it, if you expand it further, then you have here other fees that they're charging. So they're charging for administrative storage fees, application fees. And maybe in another case, you know, there's like parking. Now I'm not sure here where's the parking fee mentioned, right? And so they have like all those fees. And so you're also able to model the other fees, so other income components besides rent relative to the immediate neighborhood. And that's because you have rental listings data. So imagine if it was made available in general, like in the commercial space, and to have it like for everything, and that's the other income. Then based on like how many, for 210 units, how many units they tend to post and be available, you can infer maybe approximately what the occupancy is on that building. Even though it doesn't mean that that's a vacancy, of course, they may be listing it and then turning it over right away, but you can kind of try to approximate and infer, okay, that's a building that seems to have more vacancy than other buildings. And then you can incorporate that. And then the last thing is utilities. This one doesn't mention utilities, never mind. But like, so many of them would mention utilities. And so then you see, okay, what it's rental listings is the place to see what utilities are billed to tenants. So that's like another reason. So really that's what makes it, I feel, more powerful than, or just pulling the Prospect Now feed and, you know, direct mailing to all the owners, etc. Because here one can really try to, in a data way, discover buildings which are actually, you know, which have rents below market, which have other income components below market, which have their utilities not utilized in the best way, and you know, try to gauge their occupancy and that. So I mean, there's like rental listings are listed for commercial on other places as well. I mean, there's an apartment finder perhaps, and other you know, other resources, but yeah, I think the general spirit is how do we model it at scale on that end. So this is like one approach in my mind.
Thanks, Stefan. Just amazing. Atlanta, Georgia, the rentals are so expensive. They go up to $7,000 for 3 bedroom. Shocking.
That's what the building showed.
Is that Atlanta, Georgia?
Yeah,
It's so
right.
expensive.
Yeah, well, yeah, that's true. Mhm. Apparently. So we have another question on the chat. So is skip tracing leads through white pages fast people search possible through web scraping? Sorry. Yeah, I think so. I mean, I think that's how these companies collect their data. So yeah, I think that's primarily, I mean, they already hire people who do it manually, like virtual assistants or etc. But generally, most of those lead generation tools, it is possible. Just one would, for example, for Facebook, it's a little bit tedious to do, like it's a little bit tedious, like to maybe scrape it, because there's like this whole thing of like you have to scroll like infinitely, like forever down, like in different groups and etc. But it's not super hard for like professionals who do it, and so yeah, so they can go to Facebook groups and collect data there, or collect data on individuals just from Google and various other sources. And I mean, that's how marketing lists get built. So it's really going to social media and going to Google, and either meaning for people to reach to, as well as for properties. So yeah, I mean, if you guys have more questions, let me know. So we're going over time a bit, but I'm available myself. And yeah, so just so this webinar is going to be on YouTube. So this is our YouTube channel. Yeah. Okay. So thanks to everyone for joining us. Have a good night.